When I'm working with a potentially new client, usually the first thing they want to know is what's the value of their business. And as I explained to them, they have two ways to calculate that value or figure that out. And the first one is very formal, probably cost anywhere from between $8,000 to $12,000 to get a formal conclusion of value that be prepared by a licensed business valuator. The second one is more of a rule of thumb, and it's a street value or going to market value. And we can put those together here. It usually takes us about 5 or 6 hours to go through the data to put one together. And it's a 5-step process. So anyone looking to do a valuation for their business for internal purposes, stick around because I'll show you the 5-step process and how you can actually go through that process and calculate the value of your business. As always, if you've got questions as we go through this presentation, please feel free to drop me an email or simply give Bill or I a call. We'd be more than happy to answer whatever questions that you might have. In addition, if you get something interesting out of this, please hit the like and think about hitting this subscribe button. So with that, let's get started. The rule of thumb in a market range valuation. So what we usually look at are two separate methodologies. One, an income method, and two, an asset method, which is also known as the adjusted net book value of a company. So let's start with step one, income. Now in that first step, we're going to look to normalize or recast the cash flows over the last 3 to 5 years of a business. And we usually start by taking the tax returns for a couple reasons. One, your accountant has gone through your books, formalized them, filed them with the IRS. And two, a bank is going to be using those as a source of truth, as well as a buyer doing due diligence. So we want to use that as your source of truth. And with that, we're going to take and recast the income off of that tax return, and we're going to look for things like non-business expenses, non-reoccurring business expenses, where you may have had, say, a one-time attorney fee for something or insurance or something of that nature that's not reoccurring on an ongoing basis. And then finally, make market rate adjustments to, could be owner's comp, it could be rent, could be a lot of different things. So with that, let's take a look at an example of how you'd normalize an income statement or your tax returns for 1 year, and then we'll put it all together with a 3 to 5 year spread. So in establishing the cash flow or benefit stream for this company, let's start with 2022. And we took their tax returns. They had sales of about 8.7 million. Cost of goods sold were 6.6, giving you a gross profit of a little over $2 million. They had operational expenses of 1.1 million and giving you a net earnings before taxes of about just less than $1 million, 979,000. So from there, we'll start the add back process. And we're just taking the interest off of page 1 of their tax returns was $12,636. They had no depreciation or amortization whatsoever. So that gave them an EBITDA of $992,000. So from there, we're going to take a look at the normalizing adjustments. Now, they have a husband and wife team, and we had to do a market rate adjustment for that individual's salary, or one of the two owners. So currently, the wife was making $84,000 a year, and to replace her in the business would cost about $100,000. So we made that adjustment, giving us a normalized EBITDA of $976,000. Now, to calculate the seller's discretionary earnings or seller's discretionary cash flow, we then add back the owner's salary. And that owner was pulling a salary of around a little over $210,000. You add back also the taxes that are associated with that from a company basis, and you get a seller's discretionary cash flow of a little over $1.2 million. Now, from there, we want to take this and complete this looking backwards over a 5-year period. In this slide, you can see what a 5-year history looks like for the company. So why is this important? Well, it's important for trend analysis to try and take a look at where the company was 5 years ago, how it's grown, and what the profit is, revenue, gross margins, expenses, to kind of give you a sense to, is the company growing, is it staying the same, or is it on a downward trend? And that becomes incredibly important in two aspects. The first is when you calculate a multiple, you'll want to heavily think about various items, and we'll go through that in a little bit later. The other one is when selecting the years that you're going to average together, or how you're going to calculate the cash flow that best represents the company on a go-forward basis. So with that, let's take a look at multiples and a weighted average cash flow analysis. So you've completed step one, which was to recast the company's cash flows over a historic period of time. Step two is really determining the cash flow that you're going to use to calculate the final valuation or market range value of the company. So let's take a look at this next slide. And really what this has done is taking the seller's discretionary cash flow, which is the bottom line off that 5-year spread, and then pushing it into this form, which allows you to take a look at the history and the trend of this, the cash flow. Now in this instance, I've decided that what the cash flow that best represents the company's future cash flow is a weighted 3-year average. And you can kind of see how I've gone through that using the 2022's most recent on the heaviest weight, and then 2021 as a weight of 2, and 2020 as a weight of 1. So you add those three together, divide by 6, which is the total of the weights, and you come up with a valuation or a cash flow of a little over $959,000. So the next step in this process is really to think about what drives the multiples. So you're going to take a look at that history, conversations you've had with the owner, or if you're the owner, you kind of know your SWOT analysis, and think about this. So what drives multiples? Let's take a look at this slide. Driving multiples is really a lot of different things, and any one of them can be of a significant weight. But let's go through this. Size of the SDCF or the EBITDA. So basically, size matters when it comes to cash flow for any business. And really, it's a matter of the larger the cash flow, the larger the revenue, the less risk there is with the business. Consistency and trend of the SDCF or EBITDA. Again, if you're trending up year over year, holding steady, or you're erratic, or you're heading on a downward trend, each one of those have a risk associated with it and can weight you in your decision as far as future cash flows. Gross margins, again, size and consistency, trend analysis, very same thing. If you're able to sustain your gross margins and grow them over a period of time, that's great. You're staying ahead of the curve. If your margins are decreasing, that usually means there's a lot of either pricing pressure in the market and or competition, and it's harder to hold those gross margins over a period of time. Turnkey management or infrastructure. Now, this is really important when you're looking at a business. If a company has taken the time to really put in place a solid management team coupled with a good size of cash flow, trend analysis, and gross margins, you've got a pretty good bet on the future success of the business. And then numbers of owners of the business, in the business. That has to be analyzed. If you're taking out just a single owner operator and you're going to be buying the business and you've got that same skill sets or similar skill sets that the owner has, then that's a good thing. If you're taking or replacing 3 owners in a business and you're coming in and have to hire 2 others, that's a different risk factor to the business on a go-forward basis, and you've got to consider that when selecting your multiples. Customer concentration, here's another one. If any one customer occupies between, say, more than 15% of the customers of the business, you've got to be suspect. And it really is worth stating that if you've got 2 or 3 of those similar and you add those together and you're at, say, 30 to 40% with 3 customers, that's a lot of weight for customer concentration, and losing any one or all of those customers in a transition could cause the business to at least take a big step back, if not fail. And then recurring versus non-recurring revenue. So if the business has a lot of recurring revenue, customers that are on a contract, maybe they're once a year or twice a year renewals, that's a great thing, and that actually increases the value of the business. And then industry. So different industries have different multiples. Not all the time, but if you're looking at, say, construction, with this business is in, it usually has a lower multiple associated with it than, say, manufacturing or technology. So understanding the market segment that the business in is also important when you go to select a multiple or a range of multiples to apply to the normalized cash flow or benefit stream. You've completed steps 1 and 2, and now you're ready to kind of put the puzzle together and put a market range of value down on paper. So let's take a look at this. In this slide, you've got a seller's discretionary cash flow of $959,000, and taking into consideration all of the drivers of multiple, the history of the company and where it's headed, the fact that they've got multiple owners in the business, I've selected a range of value or a multiple of 3.25 to 3.5, giving you a valuation for this business of between 3.1 and $3.35 million. You've calculated the income method on the value of the company. Now let's go to the asset method, or what's also known as the net adjusted book value of the business. And we're going to start by doing a little bit of the same thing we did when we started on the income side, which is recast the balance sheet. Now in this exercise, what you want to take a look at is, in normalizing or recasting that balance sheet, is you want to take a look at excess cash or accounts receivable and remove them from the business calculation. We'll actually add them in at the end. But what you're looking for is the business as it would operate with a normal cash flow and a normal working capital. Now, I've seen a couple businesses that I've sold and done valuations for where they've had as much as $1 million or $2 million of excess capital sitting in the business that they needed to take out before going to market. Just eliminates a whole lot of problems in negotiations when you move downstream. But anyway, you're looking at taking those out. So take a look at the normal accounts receivable, what's kind of normal on a month-over-month basis, as well as the cash. If they've got real heavy cash, you may want to take some out of that, and make sure you calculate what you're removing out of that balance sheet. And then take a look at non-operational assets and debt. So a lot of owners take advantage of personal perks: boats, airplanes, second homes, condos, or actually the building that they may be in operating the business out of. So real estate that's owned by the company should be valued separately and added back in after you do all these calculations. And the reason is you're valuing the business, not the real estate. So once you've taken a look at those, then go down to look at shareholder. So does the shareholder, the owner, have notes payable or receivable in the business? And if they are, they should be taken out to just show the net equity, again, of the business. And then finally, you're going to take a look at the fixed assets. So all of the equipment that's in the business, and you want to mark that to fair market value. Usually for this exercise, we'll walk through with the owner and talk about the big items that they've got. If they've got a trucking fleet, we'll want to know, okay, you think the fair market value is 50% of the actual acquired value? How old are they? When are you going to start needing to replace them? So those are the types of questions that you're going to ask when taking a look at the fixed assets. And then finally, you're going to want to remove things like depreciation, amortization, and leasehold improvements. Again, remember, you're starting to take a look at the value of a company and the balance sheet, the assets that somebody else would actually purchase when taking a look at buying or valuing the company. Now, with that, that's that first step. So let's go to the second step, actually calculating the net book adjusted value for the company. Now in this example, we have current assets of $279,000, fixed assets of $215,000 against current liabilities of $1,220,000. And I'll explain why that liability number was so high. And this actually created a negative, net tangible assets or equity in the company, which is true. Now from that value, you want to calculate the indicated adjusted net book value. You're simply going to add back all of the excess cash and accounts receivable that we took out of the business when we did the recast, which was $520,000. So you end up with an indicated adjusted net book value of a negative $205,000. Now let's go back and talk about the current liabilities and why they were so high. Again, this is a construction company and remodeling company, and when they put a job together, they require a 30% deposit. And that deposit goes into the bank account, but is reflected on the balance sheet as excess billings over the cost, which is a liability. So you can see, in actuality, knowing this business like I do and asking the right questions, it's actually pretty healthy. They haven't built or started these jobs, and they have all this cash just sitting there on the balance sheet. So with that, let's take a look at the final step in how you actually calculate the market range valuation for this company. Step 6, actually figuring out the market range value for this company. Now I wanted to show you this slide to point out the obvious, I guess, Mr. Obvious here, and that is that the asset approach shows a negative number, and the income approach shows a number of around 3.35 million. Now, obviously, the value of the company is based on the income approach. And the lesson here is that if the asset approach is actually higher than the income approach, then you have a real problem. And unless you're a startup, or something of that nature, it's just really hard to take that company to value to market and to actually calculate a current value. But in this case, this company would go to market at around 3.3. We might ask 3.4, 3.5, and see where we can get an offer. But in this conversation for this company, $3,350,000 would be the market range value for the company. Now, let's do a couple additional slides. And the first one is really what we do in evaluation 9 times out of 10, and that is try and stress this number to see actually how it would perform if a buyer came into the market, bought the company at full market value, and what the cash flows would look like when you put together a debt coverage service ratio, which measures the company's ability to pay acquisition debt and an owner's salary. So this slide walks you through what a purchase price and structure might look like, and then applies a debt service coverage ratios to those numbers. So let's walk through this. You've got a purchase price of $3,350,000, a down payment, 10%, of $335,000, a 5% seller note at $167,000, an SBA loan of $2.847 million at an interest rate of 10.5%. So let's take a look at what the monthly cash flow numbers would look like when you apply that debt coverage to those numbers. So first of all, the monthly SBA loan would be $38,400. You have a seller note with, these are all on 10-year amortizations. Seller note of $2,260 and an owner's compensation of $10,000 a month. Total all those numbers together and you get a little over $50,000. Now you take the net monthly cash flows that we calculated previously, divide those by 12 to get a monthly number of just under $80,000. And the net cash flow for the business, or net remaining cash, is $29,300. So that gives you a debt service coverage ratio of 1.5 to 1, meaning that the total of the debt and owner's compensation would go into the monthly net profit of the company, the way we've calculated it, 1.5 times, which by most lenders would be totally acceptable. And remember, this is at a 10.5% interest rate. So we're stressing those numbers and going through this exercise really kind of validates the company at that price with these terms could handle the debt coverage that would be required for acquisition. A market range valuation in 6 easy steps. Well, maybe not quite so easy. But you could see that you can take a look at this process and apply it to your business. And again, if you'd like this template, we're more than happy to send it to you and you can use it. Ask us any questions as you go along the way. But kind of the takeaways here are that you're looking at trend analysis, the history of the company, you're looking at revenue growth, margin growth, and bottom line, either an EBITDA or a seller's discretionary growth. And then selecting the multiples that go along with this. There's really a little bit of a subjective turn as to the industry, and then all of the other things that we talked about as far as what actually drives multiples and then selecting the appropriate multiples. But once you go through that and then the recalculation or recast of the balance sheet, you should have a pretty clear picture as to at least the range of value that your business falls under. And then finally, putting that stress test at the very end kind of gives you a reality check. You know, are you way off? Did you miss something along the way? But it is an important thing to do because one, the banks are going to do it and they're going to be one funding the loan, and two, buyers and their buyers representatives, I'm sure, will do the same thing. So I hope you got something out of this video. If you did, please feel free to hit the like and subscribe button below to help the channel, and we'll see all of you on the next video.